Welcome back to episode 90 of the Crynet GenShow. I'm your host, and as we close out this final week of June 2026, the crypto markets have entered this classic textbook
Yeah,
phase.
the dry liquidity trap.
Exactly. I mean, we just saw this historic U.S.-Iran peace framework completely remove this massive dark cloud of geopolitical risk. You would think the digital asset market would be absolutely ecstatic.
Right, you expect instant green candles across the board.
But instead, spot trading volumes have just completely thinned out to these annual lows. It honestly reminds me of walking past a restaurant that looks totally abandoned from the street, lights are off, zero customers. But if you peek through the back window, they're secretly gut renovating the entire kitchen.
That is a perfect analogy, because that surface-level price fatigue is incredibly misleading. Our goal today is to really look at that kitchen renovation. We have to figure out why plunging prices are actually a smokescreen hiding some of the biggest institutional progress we have ever seen.
But wait, peering through the window right now, it just looks like a bloodbath. Like a hawkish Federal Reserve is starving the market of fresh cash. Retail traders are facing total capitulation. The crypto fear and greed index just slid down into extreme fear at 21.
Yeah, the sentiment is brutal.
And the average short-term holder is sitting entirely underwater with an entry around $72,600. It's not just retail either. MicroStrategy stock plummeted 35%. They're feeling a temporary multi-billion-dollar paper loss, like $13 billion on their stack of 844,000 Bitcoin. So how can you possibly call this a healthy cleanse?
Well, you really have to separate the underlying asset value from all the speculative leverage that built up around it. Let's look at the derivatives market for a second. We just saw a 4.15% drop in open interest,
Oh, wait, meaning what exactly?
meaning the total number of outstanding active derivative contracts just plummeted. Billions of dollars in borrowed bets were forcefully closed out. It is painful right now, sure, but it completely scrubs the system clean of that dangerous artificial froth.
Right, the stuff that makes markets unstable in the first place. Okay, so that severe wipeout is actually clearing the deck. But if whales are taking multi-billion-dollar hits, why shouldn't you, the listener, just pack up your bags and walk away right now?
Because exactly while the tourists leave, the real banking rails are moving in. I mean, look at SoFi Bank. They officially issued SoFi USD on the bullish exchange.
Which is a huge institutional first. That's a regulated U.S. national bank stablecoin, completely legalized by the Genius Act.
Exactly. And that distinction changes the fundamental plumbing of the market. Instead of relying on some unregulated offshore entity to move cash onto a blockchain, a federally chartered bank is injecting liquidity directly into a centralized exchange.
So the middlemen are just being cut out. And it's not just a U.S. phenomenon either. Over in Europe, the European Banking Authority is laying down the law with these strict new MiCA fine frameworks to police the space.
Which is actually exactly what the industry needs.
Wait, really? Isn't the threat of massive regulatory fines supposed to scare institutions away?
It does the exact opposite, honestly. Massive enterprises have compliance departments that simply cannot operate in gray areas. They need to know exactly what the speed limits are.
And what the fines are for breaking them.
Right. Before they put their legal neck on the line, they need clarity. By laying down strict enforcement frameworks, Europe is giving institutions the legal cover to finally enter the market.
So the Wild West is finally getting paved roads, which explains why legacy giants are suddenly moving onto networks like Solana. While the rest of the market is bleeding, Solana is actively defying the trend with net inflows.
Yeah, it's pretty wild. MoneyGram just stepped in as an official network validator there. And Moody's, the massive credit rating agency, is integrating its token engine into Solana's architecture.
Why does a ratings agency need a token engine?
Because if we are heading toward a future where traditional assets like bonds and real estate are tokenized on a blockchain, institutions need a standardized way to assess their risk. Moody's is building the engine to automatically rate the creditworthiness of these digital assets in real time.
Wow. And MoneyGram becoming a validator means they aren't just using the network to send money. They are actively dedicating computing power to secure and process its transactions. They are hardwiring themselves into the backbone.
Exactly. So the infrastructure is being cemented right now.
So for you listening, how do you navigate these newly paved roads in the short term?
Well, keep a really close eye on the $68,000 price mark heading into July. Our options data shows a negative gamma cluster right around there.
Meaning automated dealer hedging, right. What is actually happening mechanically?
Think of negative gamma as this automated wall of resistance. If the price rallies towards 68,000, Market makers are forced by their algorithms to hedge their positions to stay neutral. To do that, they have to sell.
Creating sharp sell-side friction.
Right. It essentially caps the upward momentum. So
Mhm.
if we approach that level, expect heavy volatility and immediate pushback. Let the leverage completely flush itself out.
The floor is hardening and the speculative froth is gone. But consider this final provocative thought before we wrap up. If enterprise giants like MoneyGram and fully regulated U.S. national banks are quietly hardwiring themselves into blockchain networks during the market's most fearful illiquid period, what exactly happens when macroeconomic liquidity is finally turned back on?
The structural fundamentals have truly never been more professional.
Absolutely. And that wraps up an incredibly telling episode 90. All the technical documentation on the new MiCA compliance guidelines and the Solana enterprise integrations are linked right down in the show notes.
Definitely go check those out.
To all our developers managing complex automation pipelines, coaches pushing through summer training cycles, and builders staying disciplined, keep your head down, your posture straight, and your code immaculate. Protect your private keys, filter out the capitulation noise, and I'll see you in episode 91.